An ETF is an exchange-traded fund, and basically it's a fund that trades on an exchange similar to a share or an equity. I think ETFs are growing in popularity for a number of different reasons. One is obviously its ease of access through being able to trade it on the exchange. So if you've got a brokerage account, you can buy something like the FTSE 100 in one share. They're usually very cheap, so they can be as little as 10 basis points on an annualized fee, and there's lots more of them, so you can build a portfolio very easily and self-invest. The advantage of ETFs over mutual funds are really, it's more to do with a sort of Amazon Prime generation. You can have a lot of portability with an ETF. You can hold all your holdings in one account. You don't have to fill in multiple forms, send off checks, wait for the results to come in. As soon as the exchange opens at 8 o'clock in the morning, you can trade the ETF, holding your portfolio, buy and sell it in 2 days, settlement the same as an equity, and ultimately you can adjust those positions in one simple form and hold it in one place. Yes, ETFs can be put in ISAs and SIPs. They're probably ideal for that because the costs are very low. You can also buy them through portfolio services where people put an ETF portfolio together for you, or you can buy them singly and make up your own choices on the holdings that you want to do. But ultimately, yes, you can put them in ISAs and SIPs. The fees and costs in ETFs range, from very, very cheap. I think the cheapest one I know of is about 1 basis point on an annualized fee, and go up to just under 100 basis points. But very rarely do you see an ETF over 100 basis points or 1%. Typically, what you tend to find is the more common, what they call beta type ETFs, the FTSE 100s, S&P 500s, where it's pretty easy to replicate and lots of competition in that. You get very, very cheap products, sort of sub 10 basis points. But then when you get more sort of niche products like thematic, smart beta, active type strategies, they tend to be a little bit more expensive. But actually, when you compare them against active funds, which can be up to 2.5–3%, which is what these things are competing against, they still come across pretty cheap. So you can have something like the Hans Global Innovative Technology, which comes in about 75 basis points, but its competition is probably something like the Polar Capital Technology Fund, which comes in at 3%. So that's the sort of quantum of difference that you can see. Well, I don't think there's a huge amount of risks versus listed stocks in terms of trading ETFs. I mean, by definition, you're diversified because usually it's a basket of securities that you're trading within one single trade. Whereas obviously with a single equity, you're betting pretty much on the success of that company. So there's no real diversification. Obviously, the potential for gains on a single trade in an equity could be a lot more significant, because by definition, with a basket of securities, you're probably going to have some winners and some losers. So you've got a bit of a difference there. But essentially, I don't think there's a huge amount of risks that are inherent in ETFs versus single stocks. ETFs are quite similar to investment trusts. In fact, I would say that investment trusts were the forerunner to ETFs on the basis that they're both listed and trade. They're both collective investments from that perspective. The major difference is that ETFs are open-ended, whereas investment trust is closed-ended. And an ETF can't actually leverage its underlying holdings where the investment trust can. You can have a leveraged return in an ETF, but the underlying fund itself cannot borrow to be able to expand its assets and have leverage inside the fund. So that's really the major difference between the two. So basically, to be able to trade an ETF, it's a listed security on an exchange. So you need to be able to go through a broker. So typically, any of the stockbroking wealth management firms, or online stockbrokers, or even some of the big fund houses like Hargreaves Lansdown or AJ Bell, or those sorts of organisations, Brewin Dolphin. All these firms have access to the stock exchange, and they'll have a terms of business with you. And they'll make a view on whether the investments are suitable for you. But once you've got those terms of business set up, you can trade on the exchange as you would any equity. You can use the same order types, limit orders, market orders, all the same thing, and once you've got that access, you can trade them through those sorts of people. It's very, very straightforward.